What is the main cause? It's a heavy one. What is the main cause of inflation? Why are interest rates rising? And why do the prices of gas, food, and etc. all go up at the same time?
I guess I can take the first crack at that. I'm sure there will be other thoughts there. I mean, that's it's a great question. It's a lot to unpack on that question. But what I'll say first is that, we've been in a period of time, we can go back as far as the great financial crisis back in 2008, where we've had really unprecedented stimulus, fiscal and monetary stimulus, pushed out into the broader economy that has built on itself over time. And for a long period of time, that did not rear itself in the form of higher inflation. Everyone was waiting for it to happen, but inflation remained stubbornly low and deflation was the order of the day. But as you come forward and now you move toward the more recent times and the COVID experience that we went through and the impact that had on the economy, you had a period of time where corporate America essentially shut down. No one knew what was going on from the virus standpoint. And then as we started to emerge from that, folks were, excited about being able to move around again, and they decided they wanted to spend money. They were cooped up there in their house, giving an example of what could lead to inflation. And so you saw this immense demand start coming out, which ran headlong into things such as, extremely bottled up supply chains for the exact same reasons that the people that were spending money were staying at home. Folks were, wrestling with the virus. They were trying to be back in their jobs doing their thing. You had, legions of tankers sitting off the coast on the West Coast that couldn't bring goods into the port for a litany of reasons. So you had that. There were just complete shortages of raw materials needed to make things. And then also you had another, significant round of stimulus, again, from the fiscal and the monetary standpoint, that really were flushed into the system to avert what was believed to be, the potential for a really catastrophic effect on the economy. I think what happened, though, was that, they met this crisis, if you will, with, maybe the wrong tools, and everything rebounded much quicker than they expected. And it's been very difficult to kind of tamp down this demand. It shifted from goods to services now, so folks are less inclined to be buying durable goods and other, tangible things, and are back to traveling and back to doing things that are, whether it's eating out, things of that nature. And then also, we also have a pretty large shortage of workers out there. Folks have exited the workforce. They haven't come back in for a number of reasons. So that's created a environment where the workers who are highly qualified in any industry are really able to name their price as far as, salaries and things of that nature. So why are interest rates rising with that as the backdrop? They're rising because, inflation is running at a generation high. And, the Federal Reserve, which conducts monetary policy, has a twofold mandate: price stability being one of them. And so they are raising interest rates, their tool, which is the Fed funds rate, which is the overnight interest rate that they control, to tamp down the exuberance that's in the economy. It takes a little bit of time for that to happen. So they were behind the curve because they were of the view in the beginning, whether you believe them or not, that inflation was only going to be transitory. It's turned out to be much more entrenched. So they've had to move very aggressively and quickly to bring interest rates to a level to where they can start to bring demand and supply, and specifically the labor force, back into a balance. And that's a fight that they're going to continue on. They just met yesterday. They raised rates a significant amount again. They've tweaked their language to talk about, how to expect that going forward. It's less about the pace, meaning, maybe they don't do these big chunks any longer of interest rate increases, but really think about it: where are interest rates ultimately going to end? And they needed to end in a place that's restrictive and keep it there for a while. That way, the economy cools down enough to where we can bring supply demand back into a balance, and then inflation can continue to cool off. Because once it becomes entrenched, it's a very difficult thing to wrestle with. And I'll stop there and let the other panelists have a go here.
Yeah, I mean, I could probably add a couple of things. I think the first point I like to make is, there's not a necessarily the perfect number out there that can define inflation, right? I think if you went back 5 years ago, everybody was complaining about CPI being too low, right? I can't tell you how many clients I went to see and they said, that CPI number is terrible, but I'm paying a lot more than I was the previous year, but that number's so low. And now what is everybody saying? That number's too high because it's not reflecting things that are actually starting to fall here when you look at a pricing perspective. So that's the first point. Second point I would say is that just going forward, I think we're on the path to inflation coming down. And we've outlined this 5-step process, and Jason mentioned a couple of them. I think the first step, it's already happened. Commodity prices, right? It kind of let us up. They've already started to fall. You pick your commodity, it's probably down 20% or more, whether it's oil, aluminum, copper, even some of the agricultural commodities, they've already come down. Second, you've already started to see goods pricing come down. And I think you're going to continue to see those goods prices come down. I think one of the biggest telltale signs for me was that Amazon Prime had a Prime Day, 2 weeks ago. And believe it or not, the sales on that day were really not meaningfully different from a normal day. What does that tell me? That tells me that there's still a lot of businesses out there, to Jason's point, that have a tremendous amount of inventory that they have to get rid of. By the way, if you looked at Nike's earnings, Nike said that their inventories are up 40% more than they were last quarter. The reason for that is because they're getting all that old inventory that they ordered previously all of a sudden, and they're getting the new stuff they've ordered simultaneously almost, and that's building it up. And to Jason's point, I think it's important to recognize that this time last year there were 106 ships sitting off the coast of LA and Long Beach. Today there's 6. So that tells me that the supply chain is really starting to improve, and you're going to see goods pricing come down. You're already seeing it reflected in used car vehicles, et cetera. So I think discounting through this holiday season is going to be pretty big. Third, service prices. I think we're right now in the window of seeing them come down. We went through that summer of what they call travel revenge. But if you look at online booking sites, you are seeing the price of hotels starting to come down, airline prices starting to come down. Fourth, we think we're in the process between now and the end of the year, food prices. We had our restaurant analyst on. We talked to him regularly, and he talked about the fact that if you look across the board, protein prices are coming down. Chicken, beef, eggs, and then if you want to look at some of the other things like wheat and corn, they're starting to come down. The reason that's important is because part of that CPI number is food prices away from home, which are restaurants. He thinks you're going to start to see prices there start to flatline. And then the final point is shelter. That tends to lag the housing market by about a year. The housing market's starting to slow. So about this time next year, you're likely to start to see those prices in the CPI number come down. The reality is they're already coming down. If you look at Redfin or Zillow, asking prices for rents are already coming down. And by the way, when you look at the survey for that CPI number, it's basically a survey. It asks all of us here, if we were in that survey, how much can you rent your house for? I got to tell you, I don't really have a good feel. I don't really mark the market how much I can rent my house for. So that's why there's always that delay in having those numbers come down. But I think we're on the path to inflation coming down significantly over the next 6 months.
Thank you so much. And thank you both. That was really a comprehensive answer. We'll go on to something that's coming up, that's going to be important for all of us. How will the upcoming election impact the economy?
Yeah.
Go ahead. Go ahead, Adam. Larry, go ahead.
I think it's important. Look, I think elections are important, but I think people tend to overdo what the composition in Washington is. I'll just give you the telltale of what happens in the markets. I think it's important to the markets only because they're over with, right? And if you look at the S&P 500, for example, we've had 19 midterm elections since 1945. 19 out of 19 times, the market has been up 12 months later, and it's been up on average around 14%. So just getting that uncertainty off the table tends to be a good thing for the equity markets. Now, the next question is, which is better, divided or unified government? Most people think that gridlock or divided government is better because you don't see, those big shifts in policy. And if you look at the performance of the equity markets, some of the best performance has occurred under gridlock or divided power down in Washington. However, that ignores some of the worst performance we've ever seen for the equity markets. And when you add it all up, believe it or not, you actually have better performance under a unified government than you do with divided. And it's about 10.1% versus 7.5%. The point I like to make is that those are just statistics. You always have to dig deeper. I can give you plenty of examples of where divided government's done good or bad. United government's done good or bad. And I'll just give you, a quick example in one that's on right now. When we've had unified government under President Obama, the markets were up roughly 17% on average in the first 2 years. Under President Biden currently, under unified government, it's actually slightly down, right? Well, let's look at the underlying surface. Under President Obama, we were coming out of the great financial crisis with all the spending that was taking place, right? That helped stimulate the economy and help earnings. Under President Biden, what have we had? The most significant tightening cycle we've seen pretty much in the last 40 to 50 years, right? You've seen some spending coming out. We've had a fiscal cliff this year. So I think it's important to not necessarily look at who's in power, but what are the underlying trends of the economy? What's the Fed doing? Where are we in the business cycle? Those are more important things that we've learned in our business classes that are going to have a bigger impact on both the economy and the financial markets.
Thank you, Larry.
I think Larry makes great points. The one thing I would just drive home is that I think businesses are just looking for, what are the rules of the road? They want certainty around the environment that they're operating in, because businesses are making long-term investments in their business. And if they're not comfortable, with the realm that they're operating in, they're going to be more reluctant to make those longer-term investments. So, whether it's a D or an R, as long as they have a sense, they can adapt and carry their business forward. They'll make changes to reflect stuff on the margin, but I think it's that certainty that they're looking for. And then, in the seat as a portfolio manager, we try to make decisions, agnostic of the politics, and really just look for companies that are executing well in their business plans and that have good growth prospects. And, as fixed income investors, the ability and the propensity to repay us as we're lenders to them.
Yeah. And I would just add into Jason's point, just from a micro perspective, like if I look at kind of top, priorities that come up with our clients, I think midterm elections hasn't even really been on the list lately, given all of the other factors that are at play. So I know from a kind of punditry perspective and kind of what you would read in the press, like following, it's certainly important, but just in terms of the company level, I find it interesting. It's not something that is on the top 3 list lately.
Thank you, Matt. Linda, I remember reading something that you published on recession. So the next question you could probably lead us. I hate to put it on your spot, but do you see a recession on the horizon?
Yeah, it's interesting. I think a lot of folks in the media have tried to redefine what a recession is over the past year or so. But if we follow the historical definition of a recession, we actually just came out of one, right? We were in one for the first 2 quarters of the year. We had 2 quarters of negative GDP growth. And I think that we just reported a mild increase in the GDP for the 3rd quarter of the year. But I would certainly say that given where interest rates are, given the length of time that it takes for higher interest rates to reveal themselves in corporations, and given the Fed's comments yesterday about the possible duration and the extent of the increase, notwithstanding the amount of the increase, there's a pretty good chance that we'll find ourselves in a recession, I think, sometime next year. I think we'll all hope that it's a mild one, and maybe we'll also hope that it'll have a mild impact on unemployment. I think that employment will be affected in some way, but I think the job market and the economy generally is still doing sufficiently well that hopefully we won't find ourselves in a position where we'll be too impacted by unemployment that will accompany a mild recession, hopefully.
Just to add to Linda's point, I think if we do have a recession next year, it's as of right now, I think it would be mild for a couple of reasons. I think when you think about recessions historically, normally we kind of doubt that we're in one, right? And then it comes and it's here. Like if you think back to the pandemic, we were in it before we knew it. If you go back to the great financial crisis, right? We were denying we were going into one, and go back to the other ones, 91, 2001, right? This potential recession is the most telegraphed recession we've ever seen in the history of the United States. We've been talking about it for the last 6 months, and we're probably not going to be there for another 3 or 4 months, right? And I think that's an important point, because what happens when you see something coming? You start to modify your behavior before it gets there, right? So people will start to change their spending habits before we get there, which means we don't get that cliff where things fall off. The other point Linda brought up, I think employment will remain a little bit more resilient this time around. In most surveys, small businesses, 50% of them say they're having a difficult time finding somebody that matches the criteria and skills that they need, which tells me that once they find them, it's going to be very hard to let them go, right? And most severe recessions are accompanied by massive layoffs. I don't see that really happening. And then the final point I'd make is that keep in mind that consumers still have about $1.7 trillion. Again, it's not as much as it was at the beginning of the year when it was 2.4 trillion, but we still have 1.7 trillion of excess savings in bank accounts, which I think can mitigate some of the downward movement in consumer spending. So that's why we think it'll be mild. That's also assuming that the Fed doesn't overdo it. So I will put that caveat out there, but we think it'll be mild.
Thank you, Linda.
I would just say, I
Thanks,
think
Larry.
the one last thing on that, the path to a soft landing is definitely getting a little bit more narrow. By that, I mean, just, the path to potentially a very challenging recession. But, as a fixed income portfolio manager, our job is to think about the downside, right? Because again, we're in a lending capacity. We're just trying to be paid back because we don't own a stock where it's, the growth scenario where we're looking high up. So, we constantly think about that, and we've positioned accordingly as that a recession is something that could be a real probability in the intermediate term. I would just echo the other sentiments that, heading into a possible recession or not, corporate America continues to be very resilient. They build cash, they extended out their liabilities to not be a near-term threat. The consumer did a lot of readjusting and has savings that are elevated. So if we are heading into it, we're heading into it, at a much more fiscally sound position. And hopefully that does mean that if it does come to pass, that it's a mild one and we kind of move beyond it in a reasonable time.
Yeah, and just to add on one minor comment, Linda and I talked about this briefly ahead of time, is also the banking sector is in good shape. I think that is something that even throughout the pandemic, you saw banks take significant reserves, just being uncertain about, what would happen with their credit exposures. We saw those reserves generally be released pretty swiftly thereafter. Really positive bank earnings. We just saw, a pretty good earnings picture from the banking sector overall. I think the biggest impact has been really on all of the kind of capital markets related activity. So you're seeing M&A fees are down significantly with rising yields in the high yield market and leverage finance market. You're seeing that activity has come down. But the bank lending market, which actually, really drives much of the economy, even though it's not as interesting as maybe the capital markets, most businesses in this country are funded at the end of the day through, certainly by the bond market, but the banking market's important well, and that remains functional. And banks do continue to have appetite to lend despite some regulatory capital constraints that are on the horizon.
Well, thank you everyone for that. And it's good to know that if we do dip into a recession, it's hopefully going to be a mild one. The next question I've combined with Matthew Gross had a question on growth investing. So I just combined both a question that I had before with his. With so much uncertainty in the market, how would you advise investors? Do you see a growth strategy coming back anytime soon? And that's for anyone. Just go ahead.
I think that's probably a good one for Larry to lead us on, given his role as the multi-asset thinker on the panel at this point, and we could probably fill in around him.
Okay.
Yeah, I mean, I think there's a couple of ways to answer that. First of all, when it comes to growth versus value, we have a very balanced approach right now. I would tell you that if you looked at our favorite sectors, you're going to lean more towards the value side, right? Our favorite sectors are energy, they are financials, and they are healthcare. And the reason we have those three as our favorite sectors is because they're the least expensive sectors, and they all have catalysts that can unleash value over the upcoming year, right? So when it comes to financials, as you guys mentioned, right, higher interest rates lead to higher net interest margins. So that should help that sector perform well. When it comes to healthcare, I mean, you can see all the backlogs, whether it's people getting, devices implanted, if it's just getting your regular checkups, if it's getting, anything in the healthcare space, the backlog is extremely elevated, and that leads to visibility and earnings going forward. And then when it comes to energy, we think energy is going to move higher to about $100 per barrel for oil. You're already seeing what they're doing with the average price being now down around $85 to $90, right? That's only going to just increase their cash flow, which means you're going to see more buybacks, you're going to see more dividends, you're going to see more investment for the future, which includes, by the way, renewable energy sources. So if I had to tilt one way now, I would probably lean towards the value side, but I'm more balanced in our process. I'm not giving up on, the tech sector. I think when people talk about tech, and that's probably when you talk about growth, that's where most people want to talk about it. But look, I don't think this is anywhere like the 2000 .com bubble, right? These are real companies that have real earnings, real businesses. They have real cash flow, which means that they're doing buybacks, they're increasing dividends. It's not really back in 2000 where you were like, investing on clicks per minute and things like that. I also think you have to remember that these big tech companies are diversified companies. I mean, just look at the biggest company in the world, Apple, right? It's not a hardware company. It's a hardware plus all the wearables that they make. It's also a streaming company. It's also a software company with all the apps that they produce. It's become a healthcare company with their watch and what they can do with that. It's become a finance company with their credit card, right? So these companies are multi-dimensional, more so than they were back in 2000. And then the final point I'll make when it comes to the technology space is that, obviously today Peloton was down. I get tons of clients ask me about, oh my God, technology is going to be terrible because Peloton, DocuSign, Zoom. Guess what? They're not even in the S&P 500, which is what we all look at, right? They're a very small part. When you talk about the S&P 500, 3 companies in the technology space make up about 45% of the earnings of the tech sector. That's Apple, that's Microsoft, and believe it or not, it's Visa, right? So when you're talking about tech, those are the companies you really want to worry about. And I think longer term, those are going to continue to be good sources of earning money in the future. So I'm more balanced right now. We just happen to be tilting more to the value side.
Yeah, I think Larry makes a good parallel back to the 2000 .com. I happened to be in the business at that time as well. I mean, some of the more high profile tech names you can think of or could be really struggling. I think Carvana or Uber or things, or even Peloton to an extent. But I think that's more evident of the fact that, they really worked well in an environment when interest rates were at rock bottom, financing was easy to come by. And so in a sense, that business model is being subsidized by Wall Street. Everyone loves taking an Uber when it costs next to nothing to go somewhere. Now that, cost of funding has risen fairly dramatically, and, Wall Street and other venture firms aren't willing to fund those types of ventures. I think you're seeing the real cost of these services actually come through. I mean, I'm sure folks have pulled up an Uber to go somewhere. It's much higher than maybe they recall in the past. It's just a reflection of, the true cost of that service. So to sum it up, some businesses on the margin will struggle more than others because, they're just not, they just can't generate the cash flow as consistently as others.
I think to Jason's point, one last point is I think this is a great lesson. Like when you're doing projects for in your business classes, right? A lot of times people want to extrapolate what they've seen in recent memory. And I think a lot of investors were extrapolating some of these companies that we talked about. They could grow their earnings infinitely like they did during the pandemic. And obviously you can't do that. So some of this is a payback period that we're seeing now.
Yeah, I'd also mention that I don't think we're in a market where it's probably a good idea to generalize based upon a particular industry. You all have talked about different kinds of tech stocks, right? There's a big difference right now in the performance of a company like Apple than the performance of a company like Meta. So you really have to get underneath of, you can't just sort of generalize and put all technology stocks in one bucket. You really have to look at the quality of the investment, the PE multiple, and whether you believe that's real or not. And as you were saying, Larry, it's probably not a good idea to just put a growth rate on that and assume it's going to last forever. And I believe that in any market, you can find all kinds of opportunities. Larry made some good points, I think, about travel and maybe travel moderating. On the other hand, I would say, you take a look at a company like Marriott, having worked there for 20 years, I know a lot about it. Yes, there's some moderation in travel, but here's a company who was, very adversely affected by the decline in business travel, which is only beginning to come back now, and the shutdown of China, which will open up over a period of time. So I look at Marriott and think there are wonderful opportunities for that stock to perform extremely well over the next couple of years, may be different than the average travel company. So I just think that you're in a market where you have to really look underneath for individual opportunities and capitalize on those.
Thank you, Linda. Matt, do you want to add to that, or?
Well, I would just say that the one thing too that Larry's comments brought to mind are just kind of like from a sectoral investing approach. I mean, investing is not my day job, but just the kind of convergence of different industries, I think, is certainly a theme we look at regularly going forward. So, just something I think that will continue to play out certainly over the next 5 to 10 years will be just continued investments by tech in the healthcare space. So you'll start to see some industries further kind of converge. And I think those are exciting investment opportunities as well as sort of anticipating, some of those convergences.
Thank you. Thank you, Matt. Thank you, Will. So the next question is more just based on careers and skills. What are the skills that are and will be the most sought after for people employed in finance roles or in general? If you could just shed some light on what you think.
I'll take the first crack at that. That's a great question. I know it's on top of everyone's mind that's here as a participant. I'll start off by saying, intellectual curiosity. So much of what we do, it's really, you have to have an interest in it. You have to have the ability to ask questions to get answers to the things that you're kind of dealing with in the office. There's always the more obvious things, like when we look for folks that have strong math backgrounds and interest in economics and ability to convey the thoughts that are on their mind. As a part of working at a firm like Brown Advisory, where I work, you're put in front of clients and prospects and so on and so forth very early. So you need to have a high comfort level and ability to, like I said, to just convey the thoughts on your mind, the ability to answer questions in the moment and not get that tight head feeling. And then also an ability to work, across teams with people that have different viewpoints and different backgrounds than yourself. I think those are things that we look for because it all ties back to culture for us. The thing that makes our firm be as successful as it is, in our opinion, is the culture that we've created at the firm. So job number one is to nurture that culture, keep it strong, indoctrinate the new folks into it as they come into the firm, and have them carry that flag for us as well as we move forward.
And I would, if I can chime in, I would say being very close to, we're doing a lot of hiring at the moment within my part of Citi overall. I think to Jason's point, kind of the intellectual aspects and the academic skills, technical, I think those are kind of like table stakes for a career in finance. Like those are certainly expected. But being 10 years into my career and spending a lot of my time coaching our juniors, I think a big differentiator over time is, yes, you're expected to know the technical things, but there is a lot that goes to just being persistent and having a good attitude and being resourceful. I think every year that goes by, I further appreciate that, yes, you do need to know your different cash flow models and have those skills down. That's kind of the baseline requirement, but the real differentiator is on some of those kind of whole person things that certainly are core to Loyola's mission. And just being resourceful, to me, is one of the key things. How to find information and get to the answer and be curious about things.
Yeah, I agree with everything you guys said. I think that business schools, Loyola in particular, has done a fantastic job teaching the nuts and bolts to everybody. But where you differentiate yourself, in my opinion, is in the communication skills that you have, right? You got to be able to verbally articulate the message, but you also have to do it in a written format. And I always thank Frank and Trish. One of the most recent people that we employed here was someone in the business program at Loyola's MBA program. And she has come in and really helped us elevate our game, because what I do, I'll be honest with you, it's a commodity, right? We write reports on what we think about the different markets, and guess what? JP Morgan does it, Morgan Stanley, Brown, everybody does it, right? So how do we differentiate ourselves? It's how we communicate and tell the story. So every time we come out with a new outlook or a written report, it's always got a theme on it. Right now, for example, our fourth quarter outlook has the whole World Cup theme built all around it, right? If you looked at, we've done Forrest Gump, we've done, the Wizard of Oz, we've done all these things. But the point is, we have this analogy that, if a tree falls in the woods and nobody hears it, did it make a sound? Well, if the investment strategy team makes a call and you can't remember it, understand it, or implement it, did we make a call, right? And that's why we try and drill it down. And again, that creativity, she was actually one of my students when I was teaching at Loyola as well. But that creativity, we have really been able to leverage and take our group to the next level. And those are the types of things that we look for. We assume the nuts and bolts and the knowledge is there. It's those other things.
Yeah, Frank, if I could just add one thing, I think all of these were such great comments. I would just also say never underestimate the value of somebody who's just willing to work hard, right?
Yeah. Yep. Yeah. Thank you all for that. Those are some really good answers. There was one follow-up question that was related specifically to the CFA. So I guess, Larry, you could take that, but others could chime in if you would like to. I'm sure you're all familiar with it. What is the one piece of important advice that you would give to someone prepping for the CFA, and how should they apply what they learn in books in the real world?
This is a really great question, because I know a bunch of people that haven't been successful taking the CFA, and I think you have to make a difference between the MBA program and the CFA, right? The MBA program and the way it's done at Loyola, right? It's all about application and leveraging other people's experiences and true real life experiences and opportunities. The CFA is all about being, in theory, correct. Remember, it's a multiple choice question, so you have to get that exact answer that they have, right? I got to tell you, I've had a bunch of my analysts that take it, and they're like, for example, here's a great example, right? If there's an inflationary environment, what's one of the best assets that you want to be in inflation? Gold, right? Everybody would say gold. Well, guess what? Gold's in a bear market right now. CFA would say gold is the answer. You living in the real world, gold's not the answer, no way, right? But you have to do it by the book, and you have to put yourself in that mode. And I know that's tough to say, but when you have a multiple choice question, that's the way you have to answer. These guys always make fun of me. I took it when you had to write out the answers, right? I always tell them it was harder. They say that was easier. I don't really know which one was which, but again, you got to do it by theory. That would be my recommendation.
Thank you for that, Larry. I had a friend actually who was brilliant in accounting and finance, took the CFA level 1. He failed the ethics portion, not because he was not ethical, it's just that you have to answer it in the way the CFA defines ethics. So yeah, it's a point well made. The next one, we're going to pivot a little, and it's more of an opinion, I guess, question, but any background would be helpful. What are your views on cryptocurrency and NFTs?
I mean, I could start it again.
Hey, absolutely.
So first of all, I think it's a misnomer that it's a currency, right? I mean,
Yep.
you know, when you have volatility of, 1, 5, 10% in a given day, right? That's not, for me, that's a tough thing to be when you call it a currency. Second of all, I would say that as a fundamental analyst, there's no cash flow, there's no earnings. So it's really tough for me to get my arms around what is the accurate valuation of it. I think the third point is, I think we came out of an environment where, and I'll just speak from personal experience. My brother and my brother-in-law, right, at Thanksgiving were touting how great they did in cryptocurrencies. Well, they are now, along with, 50% of people that invested in cryptocurrencies are underwater, right? And they've gotten discouraged. And guess what both of them are doing now? They've taken that entertainment dollar and they're doing online gambling, right? Because now there's another venue that it's been approved. So I think that's taken away a little bit of the money flowing into that industry. And then I do think that crypto, in some ways, to me, was getting a little bit bubblish, in the sense that when you have celebrities, right? Reese Witherspoon, Tom Brady, when you have them touting those things in commercials, when you have pro athletes taking their pay, right? OBJ and Clay Thompson taking their pay in crypto, stadiums being named after crypto.com, right? Out in LA, cities saying that that's where they're going to put their reserves. To me, that has that feeling of being a little bubblish, and it just makes me nervous. I tell investors, if they want to, it's okay. Just keep in mind, know what you're buying, right? It's a speculative investment. You can have a piece of it, and it's one of those things, you can hit a grand slam, or you can lose all your money and strike out. So, you just have to make sure. I wouldn't, get overly allocated in that.
I would just say I agree with Larry's sentiments, and I would say that Wall Street will stand up a trading desk for anything if they think they can make money. So you've seen a lot of the banks stand up crypto trading desks. I'm not an expert in cryptocurrency. I'm not going to lead anyone to believe that I am, but I will say that the underpinning technology, the blockchain, and how it's a distributed ledger platform, we can digitally record pieces of transactions across a number of online venues, and really enhance the security. I think that aspect of it is really neat, and I think that on a go-forward basis can have a lot of applications in the financial markets. Kind of an artful dodge there on crypto, but I do believe that the blockchain has a future in front of it.
Yeah, Frank, I'd say I'm clearly not an investment advisor, but I am comfortable advising this. Don't invest in anything that you don't understand.
Warren Buffett. Matt, anything to add?
Jason hit on my exact sentiment. I think the technology is interesting. We're seeing that play out. There's things that are paper-based in terms of trade finance and smart contracts that can be helped by, decentralized finance. But yeah, no comment on crypto more broadly.
Okay. So no BYAC. Okay. The next one is just in general. What does the current environment mean for startups and early stage companies? Open to anybody.
Stab at opening that one up. Yeah, I'll just say, it's probably going to be more difficult near term to get, when they're out fundraising, a lot of that easy cash. Like back in my comments around, how it was very easy for companies that didn't really generate cash flow, if any, to get funding and get really inflated, market valuations. I think it can be difficult for those more cuspy ideas to attract capital, to give them some runway to actually see if it's something that is viable from a business standpoint. I mean, I think, given the magnitude of the move in interest rates and the impact that has had on the cash financial markets, and right there I'm talking about fixed income and equity specifically, we are just beginning to see the ripple through to the non-mark-to-market parts of the market. And by that, I mean private credit, as opposed to, public credit where I'm investing. And these are, investment vehicles that are lending directly to companies, and they can be slower to mark to market or give an actual valuation of the holdings that they have. And since they have the ability to slow foot that, they're obviously going to realize any losses at a much slower pace. So I think, with that kind of being where we are in the cycle at this moment, I think it will be challenging for startups or early stage companies to get funding. Now, that being said, ideas that are incredible, very applicable technology that folks can clearly see, those kinds of companies are always going to, find eager investors to support it. So there's always an exception to the rule, if you will.
The only thing I'd say is that I'm on the other side of that, more on the investor private equity side of that. And I think one of the good things about private equity, right, is that you tend to allocate your money over a multi-period time frame, maybe 5 years, 6 years, whatever it is. So it's a form of dollar cost averaging. And if the economy does start to roll over and a lot of these things get priced at a discount, and it may ultimately end up being a good vintage year to get into those investments. I think back to the time not too long ago when oil prices were down and there were some energy private equity deals and clients were like, oh my goodness, I should have never made that investment. Well, guess what? Today, that money ended up being an incredible investment because you ended up doing what we want to do, right? Get in at the lows and out at the highs. And I don't think it's we're at this point yet, but somebody quoted Warren Buffett earlier, but he always says to be greedy when others are fearful and fearful when others are greedy, right? So the more fearful people get, probably the better the opportunities ultimately are going to be in that space. So, dollar cost averaging and private equity from our point of view, it's not a bad thing when things start to get a little cooler in those markets.
Thank you, Larry. Jason. So the next one is again from a student. What's going on with oil? If supply is the issue, why did the oil pipeline from Canada to the United States not go forward? Anyone with any opinions on either just what's going on with oil or the whole quest?
Well, Frank, I can respond to the history question, I guess,
Sure.
of the oil pipeline. So some on the call might remember that the oil pipeline from Canada was originally canceled by President Obama. And then it was uncanceled by President Trump, right? And then it was canceled again by President Biden. And the administration cites really two reasons for canceling it this time. One, they believe that it would undermine the US climate leadership around the world. And secondly, they indicated that the significance of the proposed pipeline for the US energy security and our economy is rather limited. So those were the reasons why, or at least the stated reasons why the pipeline was canceled.
Thanks, Linda.
I would just add that I think that's great. And there's just, obviously we're having this national discussion about transitioning from carbon intensive industries to renewables. That's meeting the reality though of, for example, the war in the Ukraine, the reality that we have sanctions on some of the, significant oil producing countries. And, when, for example, back to the Ukraine piece, when, we're trying to limit the access of Russian oil out into markets, you do see venues where countries are trying to take advantage of that. And, if they're having issues in their country, they can't just pivot more quickly to renewables. They lean harder on fossil. So, when you're trying to constrain demand for oil, but yet there's still a huge need for it because we're not even close to making this transition to renewables. There's that push-pull pressure on the price. And then, the price of oil is essentially, tied up in the geopolitics of the day as well. So there's that aspect that bleeds into the pricing of it as well.
I think I'll add with the price of oil. I always like to give, lessons learned right from this stuff. And I think one of the lessons learned with oil is that be careful when you listen to the headlines out there, right? When Ukraine and Russia went to war, all these people were out there saying that, oil is going to go to 150, 180, 200. There was one investment banking firm out there that said it would go up to $350 a barrel, right? We never went up there. Our target's been around $100 per barrel. And the reason for that is that, yes, there's been, sanctions against Russian oil. But the point is, their ultimate supply to the world hasn't really changed, right? They just are shipping it to different parts, China, India, Indonesia, right? That being said, obviously oil now is down around $88 to $90. We think it goes up to $100 per barrel. You know, the reason for that, obviously we're gonna have to start to refill the strategic petroleum reserves. It's the lowest level it's been since, 1984. So I think you're going to start to see some of that help support the price of oil higher. I do think eventually you are going to see some of the supply coming from Russia fall. Not, it's going to be their own fault, right? In the sense that, oil wells break over time, right? There's problems with them. And the problem with that is that every major integrated oil company has gotten out of there. So when things break over there, they can't get them fixed. So our energy analyst thinks over time, you're going to slowly see their oil production start to dwindle a bit, which marginally is a big impact on oil prices. So we think that marginally you'll see the price of oil move up to around $100 per barrel over the next, 6 to 12 months.
Thank you so much. And so we've got about 8 minutes left. So what I'm going to ask is, in closing, give some closing statements and just tell us about anything that you may have wished we had asked you today that you would like to share with us that we didn't ask you during this 50 minutes. So anybody would like to start, please go ahead.
Yeah, Professor D'Souza, I have some questions if this is open to the floor.
Sure, of course, go ahead.
So speakers, thank you so much for coming. Great opportunity to get in front of you. Larry, I have a couple questions for you, if you don't mind, given your background. What do you need to see to call a bottom in equities? And there'll be a couple follow-ups to that, if you don't mind.
Sure. The answer that most people are going to say is that they want to see capitulation in the market where everybody comes off and is selling at the same time. In today's
I would be
market,
interested in more specifics around metrics. Maybe EPS declining to say 220, PMIs breaking 45 in combination with, say, equity risk premiums moving up. If there's anything more specific you could provide outside of what we hear on CNBC, that'd be amazing.
So I'm going to give you the other side of it. So I'm going to go step by step. So if you look at what's being priced in from a economic perspective, historically, we all said we were thinking about we were going to see a mild recession. On average, mild recessions, 25% decline. We've already been there, right? So I think we've already priced in a mild recession. If you look at some of the research that we put out, to your point, there is a very close relationship with earnings and where the S&P 500 goes. Right now, earnings really haven't rolled over all that much, yet the S&P 500 has rolled over. The reason I believe that's happening is because I do believe that the earnings for next year, people believe they're going to go south of $200 $200 for the S&P 500. Our expectation is it's going to be at 215. If we're right at 215, which by the way is lower than what consensus is, but if we think it's going to be 215, we think you see a bounce back up for the equity market. When you look at some of the other indicators that we look at, and maybe they're a little bit more shorter term, when you look at the percentage of people that are bearish on the market, right? AAII, it's up to 60% people bearish. Historically, when you've gotten to those levels, 12 months later, the market's been up 100% of the time, been up 33%. We look at other metrics. If you look at the University of Michigan, they ask a different segment of people, more consumer related. You think stocks are going to go up or down? Over 44% say stocks are going to decrease. That's a very high level. Historically, 80% of the time the markets are higher 1 year later. And, it's up on average around 18%. Those are some of the things that to me have priced in a worse environment than what we are expecting going forward. So I do think from our vantage point, we do think that the lows are in unless the Fed takes us into a more severe recession. One last point, and maybe I'll address to Frank something that we didn't talk about. A lot of people like to time the market, right? We've done this analysis where we went back to 1945 and we invested $100 per month, okay? And we did 3 scenarios. We put it in the first day of every month. We put the money in cash, and then at the peak of the year, we invested the money. We put the money in cash and we invested in the trough of every year. If you do that for the last, whatever that is, back to 1945, that equates to a little over $93,000. Okay. The more important story is it's the power of compounding. Each and every one of those investments are north of $4 million. What is surprising is that there's very limited difference between if you got into the peak of every year or the trough of every year. I think the difference, the high is 4.7, the low is 4.2, dollar cost averaging is 4.6 million. So my point is that everybody puts in all this, I got to get in at the low, I got to get out at the high. The reality is the more important story is to consistently put money into the market. That's the way you build wealth longer term.
Thank you for that. Follow up. Once the bottom's in, what's the equity playbook look like for you? I know you guys spend a lot of time doing research and writing reports. How do you view coming out of this new economic cycle that'll be birthed?
Yeah, I mean, obviously you want to look for the ones that have been hit the hardest. I mean, I think we're itching to look at more cyclical sectors, right? Particularly technology. I think that's going to continue to be an area. Obviously, it represents such a big part of the equity market. I'd like to get more aggressive in the industrial space because I think that's going to be more cyclical. The biggest problem that we have, to your point that I think you're getting to, is it's our biggest worry from an economic perspective. If we go into a recession, I challenge my economists all the time. What's the next big catalyst in this economy that gets us moving, right? It's not an energy revolution, probably. It's not a tech necessary revolution. What is that next thing? And that's where we're really struggling, that if we go into a recession, the Fed takes us into something deeper than what we expect, what really gets us to that next level? Same thing for the tech space, right? You've had the cloud computing recently. You had the internet. What's that next thing for tech, right? Obviously, Meta really hasn't been that catalyst that people thought. Is it AI? Those are the things that we're going to be looking for to determine how aggressive we're going to be in those type of sectors going forward.
Last question. You started to hint at your view on inflation. What is that? And then how might that impact margins over the next 3 to 12 months? It appears that rates have really driven a tremendous amount of this move lower, and EPS for at least this year has been okay, and next year is just starting to roll over. So just curious, with the inventory build and deflation around the pike, what is your view on margins? If you could provide a little color there, that'd be great.
Yeah, so two things. First of all, if you look at the performance of the market, right, both bonds and stocks have been down, and correlations have gone to an incredibly high level, the highest they've been in 20 years. Okay, you listen on TV when I talk about headlines, everybody says I want correlations to fall. I don't. I want correlations to remain elevated, because what has driven the negative performance for both the equity market and the fixed income market has been inflation. Inflation has driven, to what Jason said, interest rates higher. That's hurt the bond market. The most significant declines you've seen there. Higher interest rates, higher inflation drives the PE multiples of the equity market lower. That's why both of them have been hit. My point is, I want those correlations to remain high, because we've just experienced the negative side of high correlation. I think we're going to experience the positive side of high correlation, where both of them can rally, right? I think interest rates will ultimately fall. I think the equity market can once again start to go higher. Our target for next year is 4,400. To your point about margins, broadly speaking, yes, they're going to contract a bit, but I think this is a longer conversation where you almost have to go sector by sector. Clearly, retail is going to have some trouble, right? Discounting a lot of their goods. Some places in communication services where it's become highly competitive, right? You're going to see some margin contraction areas. You have more and more entrants. But I think in some areas where they're going more multinational, where you can get some more pricing power, I think that's a place where you could go. By the way, one thing that we didn't mention on this call is the dollar, right? How that's hampering some investment for multinationals. So I think that's more of a sector by sector. It would probably require a lot more time than we have on this call. But
well, Larry, thank you so much for that. And just to be mindful of people's times, it is right at 6:01. So first of all, I'm going to thank our fantastic panel, Larry, Linda, Matt, Jason, Trish, and Madison. Thank you for putting this together for all of us. If anyone wants to, Larry, if you want to finish your thought, please go ahead. But I would just like to thank everyone for attending this panel too. We fit a lot into this 1 hour. And so at this point, if anyone would like to leave, you can. I think I'll just keep it on for about 5 more minutes, Larry, if you want to finish your thought, or if anyone wants to have just say any closing remarks. Thank you.
I just want to thank everyone for the chance to communicate with you. And I would say just take advantage of these types of events and really spend a good amount of time, creating your own personal network, whether it's, meeting us in person, hopefully, asking questions and finding, common interest and connections, because I think that'll go a long way as you move beyond your time in school and out into the workforce. We see it in our company. It's extremely competitive for any position that opens up. So, I think the power of a good quality relationship, it can really go a long way towards helping you, land the starting job that you're looking for. And I'll leave it at that.
Matt, Linda, any closing comments?
I would just say thank you as well. This has been a great event. And from my perspective, I know one thing is just thinking globally. That's such an important part of my role and something that I think Loyola always emphasized. But I think that'll continue to be a valuable skill set going forward. And to Jason's point, just finding something that, outside of the textbooks in the real world, you're passionate about. It certainly keeps you going when you're working in a finance role or something that requires longer hours.
Yeah, I just want to say it's been a real pleasure to spend the last hour with Larry and Jason and Matt. I hope the students on the call have learned a lot, because I've learned a lot during the past hour. So thank you so much for that. And I guess in closing, for my part, I would say, there's a lot of pessimism out there. I would just encourage people to never underestimate the strength of the American consumer. I think we have cause for optimism, and I think things will be better than we think.
That's a fantastic sentiment to end on. Thank you, Linda. Thank you, Larry, Matt, and Jason. And thanks, everyone. I hope you all have a good night.